With all the stuff going on, it's easy to kind of get lost, kind of like what Philip talked about, lost in all the noise.
Yep.
What's key to you? One or key points?
Well, first of all, I think the Federal Reserve people are underestimating that the Fed is still the most important driver for the markets. And while I don't think the policy statement is going to be alarming this week, I do think that there's still a risk the markets are priced in less Fed rather than more Fed. Again, it's about positioning. Think about where markets have come over the last couple weeks versus where they were. The reality is that earnings have come through almost in line, but the earnings season now, which once was supposed to save us, if anything, I think continues to remind us that there are certainly factors in the economy that people are now pricing differently than they were 3 months ago.
And we're just getting started. Of course, Caterpillar down 9%. It's kind of spooking everybody out.
Those numbers weren't awful. I mean, and
no, that's the point. The market is reacting so vociferously to numbers that are just, that's what makes people nervous, I think, is that, okay, a little miss or a little this or a little that, and a big move.
We've been well flagged on
Look at Macy's a couple weeks ago.
On a lot of the dynamics in trade. We've been well flagged in terms of the global cyclicality. The reality is that today you get a slew of biotech and in addition to, of course, Apple after the bell. There are parts of the economy that are going quite well. I think people have gotten very lost, that there are valuations out there that have become extremely attractive, especially across the industrial space and some of the cyclical stuff.
Is the Fed going to get it right?
Look, I think the Fed is always, by definition, supposed to be a step behind and therefore is reacting. Look, the Fed seems to have clearly adjusted their language. The market clearly was offsides in terms of their expectation of how aggressive the Fed would be. And I think right now the Fed is in more of a wait-and-see mode, and that's probably what markets need. Remember, the key to last week was really the sense that the balance sheet runoff was starting to ease up.
That's it. So I was going to, you sort of stole my next question.
Yeah.
You stole my next question.
I hate doing that, Brian.
Yeah.
But you always have one behind it, so here we are.
I'm the guy behind the guy behind the guy, which is also known as my producer in my ear. Here you go, which is this. We're going to talk a lot tomorrow on Power Lunch, 2 o'clock, about the Fed rate decision, as we should. But is that more or less important than the balance sheet runoff? What matters more, the quantitative tightening or the rate itself? Well,
I think both the rhetoric and the reality of the tightening. The tightening, you know, for a lot of people that aren't into the nuances of Fed policy, and this is not nuanced except for the fact that a lot of people hadn't built that into their growth projections and the drag on the economy. I think the runoff of the balance sheet right now is the fundamental issue. We know that the Fed is going to be data dependent. The rest of the stuff, though, or at least the Fed runoff was almost the robotic part of what people said, hey, hold on a second, you really are supposed to be reacting day by day.
You know, our friend here on CNBC, Scott Meinert of Guggenheim, has a line where he says bull markets don't die of old age. They get taken out back and shot in the head by central bankers.
Right.
Do you think this central bank is going to screw it up? Or, despite some early missteps, they're going to be able to make sure that they can run this economy, which looks like it's slowing a little bit, into a gradual landing?
Look, let's be clear. The Fed balance sheet is at 11% off of the all-time highs. So the Fed has a lot of work to do, and I think the Fed needs to be focused on that. However, you can't do that in a vacuum. Every other central bank, Mario Draghi has just said in the last 24 hours, we don't see growth slowing yet, and we will be prepared. And I think every other central bank is probably got their finger on the trigger more than the Fed.
I'm gonna go deep into the conspiracy theories here, which I normally don't do, but hey, it's fine. It's fine. The show's almost over. Why not? I got nothing to lose. There are those out there, the far fringy Fed folks, you know what I'm talking about, that will say the entire bull market stock run of the last 7 or 8 years was simply the Fed balance sheet, $4 trillion being inflated, and therefore once it's deflated, all that equity gain is going to go with it.
What I would say is forget that conspiracy. The reality is that the central bank put, and the fact that we always knew that there was going to be more liquidity behind the next door, or more to the point, liquidity was not being taken out. We've had 9 years of liquidity being thrown at us. Just the mere fact that that's coming out for the first time is painful for markets. We've seen that in the last 12 months when that's been heightened.